Hey everybody, Rob Maurer here, and today we are talking a little bit more about the possibilities for Tesla and S&P 500 inclusion. This is a follow-up episode, part 2 of this discussion. The first part does have some necessary context to make sense of this video, so definitely watch that first if you haven't seen it yet. Alright, as a reminder from that first video, we walked through the hypothesis that if Tesla is added to the S&P 500 index, that means the roughly $4.6 trillion in assets under management tracking the index would need to add about 26 million shares of Tesla stock. Also remember, we ran through scenarios of Tesla at $1,600 per share and at $800 per share, and Tesla's share price doesn't actually affect the number of shares that would need to be purchased by these funds very much. Overall, it's pretty insignificant. So for today's conversation, we're going to ignore that variance. Coming out of that first video, I would say the biggest question and point of discussion was around timing and when these funds would be buying Tesla stock if Tesla is added. I did address that in the first video, but there does still seem to be conflicting points of view on it. So I think it's worth going into a bit more detail on the topic. First, let's revisit the quote from my source, which unfortunately does have to stay anonymous, but I am highly confident that this person is well informed on this topic. Remember, they were speaking with someone that has direct knowledge of these situations. On the timing of buying, he said, quote, "I asked him if it's a singular moment, and he said no. The managers have a pretty good sense that something's going to come in," end quote, adding, quote, "He said they basically have the month prior and the month after," end quote. So keep that in mind, and we're going to come back to it, but the other source that I cited was from David Blitzer, the former chair of the index, who had previously written in a blog post, quote, "A portfolio manager running an S&P 500 fund is not constrained to buy only at the close on the day the stock is added to the index. He or she can buy at any time, can spread their purchases over a few days or weeks if they believe they will get a better price. The flexibility gives the portfolio manager an opportunity to time the buying to his advantage and use his understanding of the index," end quote. So clearly from both of these sources, we can be confident that the buying can occur over a span of time that can be weeks or maybe even months. But a lot of that discussion was around the uncertainty of when buying could actually start. Does the S&P have to announce it and then it can be days or weeks afterward? Or can funds go ahead and buy more speculatively before an inclusion announcement is made? The difference here is important because it might give us a clue on how much of that buying has already happened or will happen prior to an actual announcement of inclusion. While I don't know either way for certain, I do think we get a hint here from my source's quote. It says again, quote, "I asked if it's a singular moment. He said no. The managers have a pretty good sense that something's going to come in," end quote. That implies that the managers could be buying before an announcement is made. I don't see anything in David Blitzer's statement that would rule that out either. He does point out that other hedge funds may buy in advance more speculatively to flip those shares. That's a concept that we have talked a lot about. But just because he says that hedge funds can buy in anticipation like that, doesn't mean that he is saying that S&P 500 funds can't. In no way are those mutually exclusive, and his point about the hedge funds is related to hedge funds buying and adding liquidity for the inclusion event because they eventually flip those shares. So just my opinion here, but I'm not seeing anything that would preclude S&P 500 index tracking funds from buying the stock in advance of an announcement of inclusion. Now, I would imagine they would at least wait for the stock to become eligible before beginning that buying. But that's just my own thought. Nothing that I'm seeing or hearing would indicate that they can't actually buy before the eligibility happens. Specific funds may have their own guidelines that they use to add stocks. For example, it has been pointed out that the prospectus for Vanguard's S&P 500 tracking fund, the SPY, states their guidelines as, quote, "Specifically, the trustee is required to adjust the composition of the portfolio whenever there is a change in the identity of any index security, i.e. a substitution of one security for another, within 3 business days before or after the day on which the change is scheduled to take effect," end quote. So the SPY, with their $291 billion in assets under management, tries to get all their buying and selling done within that 6 business day period. But there are caveats and exceptions. They continue on to say, quote, "If the transaction costs incurred by the trust in adjusting the portfolio would exceed the expected variation between the composition of the portfolio and the index, i.e. misweighting, it may not be efficient identically to replicate the share composition of the index," end quote. Transaction cost there is a little bit vague because it doesn't specify if that's just the fees that they're paying for the trade, or if transaction costs may include the increase in the stock price that would be caused by purchasing such a high volume of shares. For example, the SPY, again with $290 billion in assets under management, they would need to purchase about 1.8 million shares of Tesla. So what I wonder in that circumstance is if they feel like purchasing that amount of shares over a 6-day period would be expected to cause a big enough increase in the stock price for Vanguard to instead be accommodating of some misweighting for some additional period of time. Now, this is just one example of one fund, and even if they don't factor in stock price appreciation from buying as part of their transactional costs that they mention here, it still shows that there are caveats and exceptions that can be in play. So this kind of brings me into my main point here, which is I think there's this assumption that all the funds just buy and match the S&P 500 index identically. That's nice in theory, but there's no way for that to really work. All the index funds can't just say, yes, we want 26 million shares of Tesla at whatever the index price ends up being, and then we're all set, we're all equal weight, and we're all tracking the index perfectly. It doesn't work that way because in a transaction like that, a 26 million share purchase, the first share of that is going to be a lot cheaper than the 26 millionth. The first share you can probably buy on the open market, but as you keep buying, the price is going to keep going up and up. You find fewer willing sellers, so regardless, you end up with a variation between funds that are trying to track the S&P 500. That variance is the concept that I want to explore here in more detail because I think it will be pretty illuminating. So the first thing we need to understand here is how the actual S&P 500 index returns are calculated. As I mentioned in the first episode, that's based on the S&P 500's divisor, which standardizes the index over time with all the changes that occur to it. An example of one of those changes being a company being added or dropped. So the divisor takes care of those things. That's all we really need to understand for this conversation. And we know from that same indexology blog by David Blitzer that, quote, the closing price is the price the S&P Dow Jones Indices uses to adjust the index divisor, end quote, meaning that whatever day Tesla is actually added to the index, the closing price on that day will be what is used to determine the return on investment of the S&P 500 index. So that is the price that these funds will be trying to track. As we just talked about, we know there's going to be variance. Not all 26 million of these shares are going to be able to be purchased at the exact same price. So I was curious how much that variance could actually impact the returns of an individual fund, given that Tesla is actually only going to be about 1% of the weight of those funds. Putting this into an example, let's compare the overall performance of a couple different funds here based on assumptions of different entry points for their Tesla position. For this example, we'll assume that on the day the S&P 500 adds Tesla to the index, Tesla stock closes at $1,600 per share, putting Tesla's weight in the index at about 0.91%. Meaning that of the 4.6 trillion in assets under management tracking the S&P 500, about 42 billion should be allocated into Tesla. Again, that equates to about 26 million shares. That means the remaining balance of these funds is 99.1% in the other S&P 500 stocks, so about $4.56 trillion of the 4.6 trillion dedicated to those stocks. For this example, let's assume that Tesla, after 1 year, approaches $2,500 per share, so a 1 year return of 56%, and let's assume that in combination, all the other S&P 500 stocks perform at about 5% for a 1 year return. That would mean the valuation of the Tesla shares owned by these index funds would increase to about $65 billion, while the total assets under management would increase to about $4.85 trillion. Tesla's new weight in the index would be about 1.3%, up from 0.9%, and the overall return for the index would be at 5.5%. That's a combination of the 56% return on Tesla in this example and the 5% return on the other stocks. So that mixes out to 5.5% total. And let's see how that 5.5% return compares to a fund that either bought Tesla at a higher price or at a lower price. First, let's take a look at Fund A here. Let's assume that they bought Tesla after the S&P 500 inclusion sort of took place. Maybe they were waiting around for a cheaper price and they never got it, so they ended up buying in at an average of $2,000 per share. They still need to end up accumulating about the same 2.6 million shares, because if they stuck with that 0.9%, they're just going to be perpetually underweight Tesla, because by the time Tesla is $2,000 per share, well, it makes up 1.1% of the index in this example. So they end up buying a similar amount of shares, but they have to sell off a little bit more of their other assets to get the weighting in balance. For this example, let's just simply assume that the funds that we are talking about make up 10% of the 4.6 trillion in assets under management in tracking funds, meaning that each are 460 billion in assets under management. For Fund A here, because they ended up buying at $2,000 per share, the 2.6 million shares that they had to buy, 10% of the 26 million in total that need to be bought, end up costing them about 5.2 billion. So at the end of 1 year, if Tesla is at $2,500 per share, they're only getting a 25% return on Tesla versus the 56% return of the S&P 500 index. If we assume that their other positions also gained 5%, the same assumption that we used for the overall index, this fund would have a total return for a year of 5.2%. So even though they ended up paying 25% more for their shares than what the index added Tesla at, they actually ended up only underperforming the index by about 30 basis points. Same example here for a quote-unquote Fund B. Let's assume that they end up buying all their Tesla shares at $1,200 per share, so $400 per share lower than what the S&P 500 adds Tesla at. Tesla at $1,200 per share would indicate a weight of about 0.7%, but again, still roughly that same 2.6 million shares. So instead of 5.2 billion, Fund B is paying 3.1 billion for their shares, meaning if Tesla's at $2,500 per share in a year, they're making a 108% return versus the S&P 500 index at 56% and Fund A at 25%. Assuming the same 5% return on the other assets, their total return for the year is 5.7%. So even though they paid about 25% less for their Tesla shares, they're still only overperforming by about 20 basis points. Now that level of variance isn't insignificant, but at least my perspective is that it's not some huge crushing variance in either direction, even though we started with some pretty big variances on the Tesla purchase point. What is really interesting here though is that because Tesla's market cap is so big, it can actually cause some variance in the overall performance of these funds. If we think about a normal stock being added to the S&P 500, I don't know, maybe the market cap on that stock is 20 billion or so. It's probably even lower than that. But for a company with a market cap like that being added, all the same math would still apply. The impact of it on the overall fund though would be about 1/10 of what Tesla is able to do. So under normal circumstances, these variances end up being really insignificant, but with Tesla being probably a top 15 market cap company being added to the S&P 500, it is big enough to cause variances in the overall performance of these individual funds. We'll come back to that idea in a second, but I do want to go one layer deeper here and really look closely at how the timing of purchases can impact this relative performance. To do this, I've created a sensitivity table of sorts here with 6 different hypothetical funds buying in different lots over the course of 60 days. I'm then taking a look at basically random share price movements and seeing how those share price movements could affect the relative performance of these funds based on when they actually choose to buy Tesla stock. The reason I think it's interesting to look at this is because it could give us a clue on how these funds may actually end up pulling this off. So if you're watching this on YouTube, I'm sure this looks overwhelming, especially if you're on a phone, but I promise it's pretty simple. We have 6 different funds here. We're assuming that all of them are the same size fund, again, at 10% of the total 4.6 trillion in assets under management. So we're assuming that they need to all buy 2.6 million shares of Tesla. To determine the share price for each individual day of this 60-day time period, I just used a random number generator to assign each day somewhere between a -5 and a +5. And those numbers are then just used as multiples for Tesla's median daily share price movement, which is about 1.94%. So if a day has a 0 here, it's not moving at all. If it has a 1, it's moving positive 1.94%. 2 would be twice that move, etc. For this example, I'm assuming that about 30 days past the start of this buying window, the S&P 500 announces inclusion. 5 days after that, they actually add Tesla stock to the index. And then I'm taking the share price on that day, as we had just talked about, to determine how the S&P 500 index would perform with Tesla in it under a couple scenarios that we will talk through. All right, so for these 6 different funds, they all have a different strategy in terms of how they need to collect their 2.6 million shares of Tesla. The first fund here is Fund DCA, standing for dollar cost averaging. They're taking a linear approach across the 60 days. They assume Tesla is going to get added after the quarterly report, so they just buy 42.6 thousand shares every single day for the next 60 days. The second fund here is Fund Bell. They're taking a bell-curved approach. They're buying more heavily near index inclusion, but they are spacing out their buys over the 60 days through a normal distribution. The next fund is Fund Early. They're trying to beat the rush. They just buy 260,000 shares each day for the first 10 days. Then Fund Late, they're doing the opposite. They're just waiting and hoping that the share price falls after some sort of bubble activity. So they do the same, but buy in those last 10 days. Then we have Fund 1 Week, so that would be more akin to the SPY that we talked about, and they're buying in the week from the announcement to the actual inclusion date. So 5 days, 520,000 shares per day. Lastly here is Fund After, and they wait until the S&P 500 inclusion is announced, and then from that point on, for the next 30 days or so, they buy linearly 84,000 shares per day. All right, so that sets the scene. I have 2 scenarios here. One, I have the share price slightly edging up over this period of time. The average multiple for those 60 days is 0.3. And then another scenario, I have the average multiple trending down over those 60 days with an average multiple of negative 0.3. I'm then taking those share prices and multiplying them by the share count that each fund is supposed to be purchasing each day. So then if we just add all that up after the end of the 60 days, we have the total cost that each fund paid for the 2.6 million shares. Then, as we just did earlier with the examples of Fund A and Fund B, we can compare how the cost basis for each of these funds would compare to the S&P 500 performance, and we can see how much variance is caused by the different timing strategies. In the first example, where the share price is generally going up over these 60 days, the average share price comes out to $1,863 per share, and the range of the cost basis for these funds ranges from anywhere between $1,623 per share to $2,151 per share. That means the total cost to acquire these shares ranges from $4.2 billion up to $5.7 billion across the funds. In this example, the S&P 500 inclusion happened to be at a price of $2,132 per share. So to perfectly track the index, these funds should have paid about $5.5 billion for their 2.6 million shares. But again, they ranged from 4.2 to 5.7 billion. In comparison to the index then, the cost basis variance here ranges from 24% below the index level to 2% higher than the index level. If we do the same math that we did before and we assume that a year from now, the other assets in these funds have performed at a 5% increase, whereas Tesla shares go to $2,500 per share, or in this case I've also included the scenario of Tesla shares going to $1,000 per share. Either way, it doesn't change the relative performance of these funds to the S&P 500, and we end up seeing overall fund performance variance to the S&P 500 performance ranging from -3 basis points underperformance to 30 basis points of overperformance. I know this is a ton of math to go through, but I think the assumption is that funds are going to buy sort of that week of S&P 500 inclusion announcement. If we look at this specific example, that strategy still led to the fund using that strategy to have a cost basis that was 9% less than the S&P 500 index tracking level. This example illustrates that simply buying the week of is no guarantee that the cost basis is going to be any closer for the fund doing that than it would be for a fund employing a different strategy. In this case, we see much smaller cost basis variances for the fund that starts buying linearly after the announcement of S&P 500 inclusion through 30 days, and then even less variance for the fund that just waits till those last 10 days of the 60-day window to buy all their shares. Obviously, the more volatile a stock is, the more variance there can be, and especially lately, Tesla has been pretty volatile. The volatility in this example I don't think is unrealistic. The week of S&P 500 inclusion in this model, the share price goes from about $1,800 per share up to $2,100 per share. So basically a $300 price move and about 20%. We've seen both of those happen in a single day for Tesla before. I think just last Monday, intraday, we saw about a $320 move. So really the only way to ensure that you're going to be tracking really closely to the S&P 500 would be to sort of buy in that last hour on the day the stock is added. But then you have to hope that not everyone is doing that, because if everyone is doing that, you're not going to get any shares. Before we continue talking about the implications of this, let's quickly go through the declining share price example. In this case, Tesla stock comes into the week of S&P 500 inclusion at about $1,300 per share and closes the week at about $1,100 per share, meaning that would be the cost basis for the index, while the cost basis for the other funds ends up anywhere between $1,000 per share and $1,300 per share, or variance of -6 basis points all the way up to 19 basis points, which would then eventually lead to 1 year overall fund performance variance from the S&P 500 index of anywhere between 12 basis points of underperformance to 4 basis points of overperformance. Similarly, in this case, buying the week of doesn't indicate any closer tracking. It ends up here with a 12% higher cost basis on the position, which would lead to an 8 basis point underperformance to the index based on the numbers that we used in our examples. So overall, my takeaway here is that there's no magic timing that is going to allow these funds to exactly track the index, though it would seem that you could minimize your risk of variance by buying closer to the inclusion date. So as I said before, I do expect sort of a bell curve of buying around that date, but buying a little bit now and a little bit later might help hedge against some of the interweek volatility that may be experienced during the week of inclusion. If I were doing it, I think the most prudent way to manage the risk would be to buy some before, buy a little bit more during, and then to buy some after. The concern with this that I've seen brought up is that, okay, these index funds aren't going to buy a stock if it's not for sure getting in the index. People think that's too big of a risk to take. Maybe, I don't know, my perspective is that that's such a small percentage of their total fund assets under management that if they do buy a portion of those shares ahead of time, and Tesla for some reason doesn't actually end up being included in the S&P 500, meaning that fund would then have to sell some of those shares at a loss, I just don't think that's going to cause a big enough variance risk to the fund to ignore the benefits that they may have to reduce their variance risk around the scenarios that we just walked through. Basically, I just expect a steady stream of buying for a couple months. Certainly some of that buying is going to be filled by hedge funds front-running this trade, as we have talked about, but I still think it's going to end up being a positive for the share price. As usual though, not financial advice. A couple other things on S&P 500 inclusion that I want to go through here. The first is on how the options market may come into play for these funds acquiring these shares. I was told again by this source that the funds wouldn't be buying call options to help fulfill their share count needs. So again, take that for what it's worth, but that's what I was told. Another consideration to make is synthetic ownership. Somebody had posted a YouTube comment about this on the first episode, so I went back and looked at the concept. Basically, synthetic ownership is from an ETF that is swap replicating an index. I think the Wikipedia page on this makes it the most simple to understand. It says, quote, "An important attribute of this specific type of fund is that it does not hold any underlying securities featured on its benchmark. Instead of holding these securities, synthetic ETFs use derivatives such as swaps to track the underlying index in the process of replication," end quote. So kind of a confusing topic, but basically a fund that you invest in that guarantees that the return will be equivalent to a benchmark index, even though that fund doesn't actually own any shares in that index. The way I imagine this playing out, and I'm not sure if this is 100% accurate, but let's say I own a bunch of Tesla stock and I expect to outperform the index, but I want more cash to invest in Tesla stock. So there's this ETF fund that I guarantee will give the same return as the benchmark index, the S&P 500, and then I use that to invest in Tesla. Let's say I make 100% gain with that money. I only have to give 5% of that gain back to the investors in the ETF. Of course, if Tesla went bankrupt, I would still have to pay that money back. So obviously there are SEC regulations around this. Because of that, they are more frequently used in Europe. But I did ask my source to ask his contact about this and how much of the S&P 500 index tracking funds may be this synthetic variety, because presumably those funds would not actually need to buy the underlying stock, which in this case we are thinking about Tesla. So he said, quote, "He ballparks the amount of synthetic ownership, which includes the swap replicating dollars, at 10% to 20%, end quote. Now, I'm not sure if the S&P 500 is including those when they talk about the 4.6 trillion in assets under management tracking the index, but if they are, and that does end up being 10 to 20% of the AUM, then maybe our 26 million share count needed actually falls to 23 or 21 million instead. Another consideration, as Gary Black pointed out on Twitter, is that there are these so-called index completion funds, and according to Black, they have about $500 billion in assets there that hold all stocks that are not in the S&P 500. Obviously, those shares of Tesla would then easily be sold into an S&P 500 buy, which would again then reduce the demand for true float shares. Similarly, as we mentioned before, there are organizations that may hold Tesla in one fund and then shift that over to their S&P 500 fund when the inclusion does happen. So the 26 million share number is out there, but there are some other things out there that could potentially reduce the true need for those new shares. The next point of clarification I want to make is on the assets under management that are benchmarked against the S&P 500. Last time, remember we talked about that. That's about $6.6 trillion in addition to the 4.6 in tracking funds. So I learned a little bit more about this. Essentially, most funds are benchmarked against one of the major indices, of which the S&P 500 is obviously a popular one. What that means is that the fund performance is rated in comparison to the performance of that benchmark. So those benchmark funds have no need to purchase Tesla stock, or they may already own Tesla stock. So a pretty significant difference from the assets under management for the tracking funds. That being said, if Tesla is added to the S&P 500, then it becomes a part of that index. So for these benchmarked funds, if they don't own any Tesla and they're underweight, that would be a specific strategy variance that they would be making in hopes of driving outperformance. The least risky strategy for those funds would be to have an equal weight position on Tesla. If that were the case, then it would not be a source of variance to their fund's performance versus the S&P 500 index. The more significantly a company is weighted in the S&P 500 index, the riskier it becomes to have a deviated position on that asset because of its impact on the performance. So Tesla at 1% does have an impact, but not quite the level of something like a Microsoft or an Apple around 5%. Last couple thoughts here. I promise we're wrapping up. This is getting to be a very long episode, but I do want to share some more speculative thoughts. The premise here is that the S&P 500 selection committee has, of course, a lot of power over the index, and they can rewrite the rules if they want to. As an example of this, around the time that Snapchat was being talked about as potentially being eligible for the S&P 500 index, the rules were changed to exclude companies that had significantly different share classes. So for example, different types of shares had different voting rights with Snapchat. So it seems the S&P 500 committee wanted to disincentivize that sort of corporate governance. But point being, they can make changes if they want to. This fact was alluded to in a report from Bloomberg from last week with a headline of, quote, Tesla inclusion in S&P 500 index may require human intervention, end quote. Continuing on to say, quote, Tesla's outsized returns this year are likely driven partly by prospects for its imminent inclusion in the S&P 500, yet a history of second quarter losses could stand in the way. If Tesla repeats that pattern, we expect the index committee to make an exception and add the automaker anyway, given its size and position in competing large cap benchmarks, end quote. Personally, as we discussed yesterday in the earnings preview episode, I don't expect that to come into play, but it is interesting to consider. The idea that I am more interested in, though, is the S&P 500's assessment of Tesla's float share count. I don't think there's anything out there that says they have to go with, for example, Yahoo Finance's float share count or anything like that. I think they'll make their own assessment, and maybe they estimate it at quite a bit lower than what we have been working with. Because weighting is established based on float-adjusted market cap, that would mean fewer shares would need to be purchased. That would do a couple things. It would ease some of the pressure that we're talking about, and it would also reduce Tesla's influence on the overall index. The S&P 500 might find that to be somewhat appealing. Then, over time, as they have their quarterly rebalancing, they could slowly increase the weight of Tesla in a way that might cause less short-term volatility. Regardless of their assessment of float, they could opt to step Tesla slowly into the index over time, maybe 25% per quarter or something like that. Our source on this topic says, quote, we shouldn't look at the market cap weighting as a 100% guarantee of its weighting at inclusion. They could start it lower, say half weight, and walk it up over a year, end quote. Now, obviously, if over that period of time Tesla stock outperformed, that would be detrimental to the performance of the index. But if they add Tesla all at once and the price skyrockets because of that, and then only goes down for a couple of years, well, that's going to hurt the performance of the index too. So a lot to consider, but I wouldn't be too surprised if we saw something like that from the selection committee. Really fascinating stuff, and whether Tesla becomes eligible tomorrow or in Q3 or the next quarter, whenever, I think it's good to know about this stuff ahead of time. I've certainly learned a lot. I hope you all have as well. And hey, if this is helpful and you want to support what I'm doing here, it is a lot of work. I can only do this because of the support on patreon.com. If you want to help with that, you can find details at patreon.com/Tesla Daily Podcast. Other than that, don't forget to subscribe, make sure you're signed up for notifications, and I'll see you tomorrow for earnings, the July 22nd episode of Tesla Daily. Thank you.